Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. My name is Devi Nur Fajrangrini with student ID number 234111165. On this occasion, I will be presenting learning material based on the topic assigned in the course I am currently taking. The discussion will cover important concepts that are expected to enhance our understanding and academic insight, particularly in the fields of accounting and management. I hope the explanation I deliver will be clear, easy to understand, and beneficial for all of us. Now, let's move on to the main discussion. Okay, on the first slide we will discuss the meaning of financial reporting engineering or financial reporting engineering. Financial reporting engineering is a concept in accounting theory that discusses how financial reports are designed and presented using various accounting methods and policies available in accounting standards. In practice, accounting standards often provide several alternative methods for companies to choose from. These include asset depreciation, inventory valuation, or revenue recognition. These options provide companies with flexibility in preparing financial statements. This flexibility allows management to determine the method best suited to the company's circumstances. However, this flexibility can also be used to influence how the company's performance is perceived by investors, creditors, and other parties. Therefore, financial reporting engineering is often understood as an effort to organize or engineer the presentation of financial information by utilizing the options available in accounting standards. It's important to understand that financial reporting manipulation doesn't always mean breaking the rules. As long as it's done in accordance with the law, accounting standards and principles of professional ethics, this practice is still acceptable. Problems arise when such engineering is used to hide the true condition or mislead users of financial reports. Thus, financial reporting engineering is a concept that is closely related to information quality, transparency, and integrity in financial reporting. Next, on the second slide, we will discuss the objectives and characteristics of financial reporting engineering. The main objective of financial reporting engineering is to produce financial reports that are able to provide relevant and useful information for users of financial reports. In an increasingly complex business world, companies often encounter various transactions that require professional judgment in recording them. Therefore, management needs to determine the accounting method that best suits the characteristics of the company's business. Furthermore, financial reporting engineering also aims to help companies present their financial condition and performance more effectively. With good presentation, financial information becomes easier to understand for investors, creditors, and stakeholders. On the third slide, we will discuss several forms and practices of financial reporting engineering that are often found in financial reporting. The first form is the selection of different accounting methods for different transactions. For example, a company may choose the straight-line depreciation method or the declining balance method. These choices will result in different expense values and affect profit. Company. The second form is the use of accounting estimates. Many figures in financial statements are actually estimates, such as depreciation of assets, allowance for doubtful accounts, or estimation of certain liabilities. Changes in estimates can significantly impact financial statement results. The next form is the timing of revenue and expense recognition. In some situations, companies may accelerate or delay the recognition of certain transactions, thereby affecting reported earnings. Current period. In addition, there is the practice of account reclassification, which is changing the grouping of a transaction so that the financial report looks better. While technically still within the rules, this practice can impact how users assess a company's performance. Then there is the practice known as income smoothing or profit smoothing. The goal is to make the company's profits look more stable from year to year, thus giving the impression that the company has consistent performance. There is also the practice of window dressing, which is an effort to beautify financial reports towards the end of the reporting period so that the company's condition looks better than it actually is. All these practices show that financial reports are not only influenced by economic transactions, but also by the policies and considerations used in the process of preparing them. In closing, on the fourth slide I will convey the conclusion of the financial reporting engineering material. Financial reporting engineering is an important part of accounting theory that explains how flexibility in accounting standards can affect the presentation of financial statements. This concept emerged because in accounting practice there are various choices of methods, estimates, and policies that can be used by companies in preparing financial reports. This option allows companies to adjust the presentation of information to business characteristics and reporting needs. On the one hand, financial reporting engineering can be beneficial because it helps produce more relevant and informative financial reports. However, on the other hand, if used excessively or unethically, this practice can reduce transparency and mislead users of financial statements. That concludes the material I can present on this occasion. From the discussion, we can conclude that each concept has an important role in supporting both theoretical understanding and its practical application in real-world situations. I hope this material can broaden our knowledge and serve as a useful reference in our learning process. Thank you for your attention. Wassalamu alaikum warahmatullahi wabarakatuh.